Deflation versus inflation. Are we going to continue this deflationary interest rate trend, or are we going to switch into high inflation? Does that mean we're going to get hyperinflation at some point, like the media is saying? And I think the key charts, we're going to look at a bunch of different bond trading, interest rate charts, money supply charts. But I think the key charts to check is towards the middle of this video. I'm going to be doing a very Jeff Snyder-esque look at the euro-dollar futures charts. And this is the international bond trading and interest rate expectations that really show not what the media is saying, but what the international real money, the whales, and the international banking system is betting on. Um, and then also, yeah, commodities and consumer prices and how that relates to the interest rates. And then, the stock market, everyone thinks the stock market's just going to explode to the upside if inflation happens. But this everything bubble has happened during a huge deflationary interest rate trend since the 70s. We've been in a huge deflationary environment, and the stock market has been bulling and just bubbling that whole time. So if we switch into inflation, is that actually a good thing for stocks? Please like, share, comment, subscribe, turn on notifications. This is going in the monetary education playlist and also the macroeconomics playlist. Check them out. This is a deep dive. This is going to be super deep. Okay, inflation versus deflation, but let's take a quick look at the stock market and see where we are. So we are still bulling in. Let me log this. There you go. Let's see what is happening. I think I see what's happening here. Okay, so I think we're doing this right here. Yep. All right. Boom. So it looks like we are consolidating underneath the peak. This is the April 19 peak. This is the same week, April 19, kind of peak reversal off the top of the bull market. And we're doing these weird flat gapping consolidation moves. It looks like we're just gapping back and forth underneath the peak in the bull channel. Maybe we're consolidating in here for right now. So probably another week we'll see if we break out bullish or bearish from this thing. I don't know if this line is a real line. It looks like this might have just crossed the channel. Anyway, it looks like Friday might be boring, and it looks like we might be consolidating under the peak for right now. So we'll see if we can break out of this thing. Maybe today, probably next week. Anyway, inflation, deflation. What's this line at? Like 41.80. So if we break above 41.80, that's getting pretty bullish. If we're breaking below 41.40, getting bearish. Yeah, anyway, okay, so inflation. I would say, in short, to summarize everything I'm going to say, is that the media in America is all over the inflation scenario. And it's just like, this is what's happening, and it's blah, blah, blah. But if you look at the international bond trading and the international monetary system, they're not betting on inflation. And so I'm going to look at several charts and a few definitions, different ideas of what inflation is and where things are kind of heading. So yeah, let's talk about inflation, deflation, and short term and long term. Let's see, can we get the M2? Does that happen? Yes, they do. Cool. TradingView is awesome. Yeah, anyway, this is TradingView, not sponsored, and it's pretty cool. You can get all these charts. Let's take the log off. Auto, so I don't know how far this goes back. So the 80s or something. Okay, so just let's talk about M2 money supply real quick. And you can see it's around 15 coming into, the COVID crash. And since COVID, we've gone from 15 to almost 20 in the M2 supply. It's like 1/4 of all the dollars in America were printed over the last year and a half, like since COVID, which is pretty crazy. Okay, so M1 is cash and checks, checking accounts and cash, and like traveler's checks. And then M2 also includes savings accounts, money markets, and CDs. So that's like spending money, like actual cash. Does not include, bank reserves. It does not include like margin loans into the stock market or anything like that. This is spending money accounts basically, and it's only in America. And so if you look at M2, I mean, that's a huge blast in money and dollars in America. So this is a huge tick for the inflation argument, and you can see that it just pretty much always goes up, and then when we have a problem, it goes up even more. And so long term, we just kind of always print more money. So that is sort of the generic inflation argument. So like if you're Austrian School of Economics, inflation is the very, very simple definition of more money supply. Like any increase in the money supply is inflation. It's more currency units. It's like that simple in the Austrian explanation. But it gets a little bit more complicated because every dollar is a loan and you owe interest on the loan. And when you start paying the loan off, that destroys dollars back out of the system. So there's kind of this wedge where you have to print, if you're just printing enough new money to pay for the interest, like you're not really increasing the money supply. So you have to print more than that to actually increase money in circulation. Because if you're just printing enough to pay the loans, that doesn't increase spending money really, functionally. So yeah, so anyway, the M2 is pretty interesting, but it's only American bank deposits. And most of the dollars in the world are not printed by the US government or by US banks. Most of the dollars in the world are printed by international banks, which loan to businesses and governments in other countries. And so the dollar's 70 something percent of all the money in the world. And most of those dollars are created outside of the US. They're not part of this M2. The US, like the Fed bank reserves, are not part of that system. So let's take a look. Let's just look at bonds. So the bonds, this is US bonds, right? And I'm going to get to like EuroDollars in a minute and start talking about where the money actually comes from. Oh, and I heard also that the Fed is going to stop printing and tracking the M2 money supply, which is crazy. So we're not even going to see even the M2 supply. And so, yeah, right. So just still on M2 also, like this 1/4 of all the dollars happened in the last year and a half or something, in the American, spending money accounts and stuff like that. But still, it's the international banking system that's creating these dollars, and they're coming back to the U.S. I know we had like helicopter money, and people are freaking out about it. And the U.S. banks also, loan money, but most of it comes from international banking. And so if you look at, well, like Fed bank reserves, not only is that not spending money, that's just a balance sheet instrument, and it's only a balance sheet instrument for U.S. banks. The international banks do not use Fed bank reserves. This is the 30-year Treasury, and so this is a look at interest rates. Like as the chart goes down, so this only goes back to 88, but in the 70s we had interest rates that were like almost 20%, and then they've come down to 0. And when people say the interest rates, they're talking about like the Fed funds rate, which is mostly targeted at the short end of the yield curve. The 30-year is a better look at actual interest rates. And so this is what determines the interest rates is inflation expectations and the bond trading. And so this is the chart of the bond trading. And you can see the bonds traded down to 1.2 or something. So like the 30-year never went to 0. But it has been in a deflationary trend since the 70s. Like we've had interest rates coming down for a very long time, whatever, like 50 years or something. And so right now we're getting an up cycle, like we're getting an up move, which everyone knows about and everyone's freaking out about it and everyone's yelling for inflation because it's making an up move. But I mean, this thing makes up moves all the time, counter trend up moves, and then it goes lower, and then it goes lower, and then it goes lower. But I guess just looking at the U.S. interest rates based on the bond trading, like right now it's making an up move, okay. But the inflationary question, as far as this goes, is like next time it comes down, does it land higher or lower? Like if it lands, I mean, there's room above zero to still go farther down here on the long-term U.S. Treasury bonds. So it could easily cycle back down and land lower, and we could continue the deflationary move. And there's room above the zero bound here. So we might not be done, even above the zero bound, we might not be done with the down move yet. And that could take 5 or 10 years to cycle back down. I mean, these things, from 16 to 20, yeah, somewhere in like the 4 to 10 year range is these cycles. And a really cool way to look at the cycles is on this chart, which is the 10-year minus the 20-year. So this cuts out the short end of the curve, like the 3-month Treasury bonds, and it cuts out the long end, the 30 years. And you just get the spread between the 10 and the 20, which is just like this is the yield curve, like how steep is the yield curve. So if the 10 and the 20 are close together, that's down here at the bottom of the curve, or even if they're below zero, that means it's inverted. If you've heard of an inverted yield curve, that's when you're down here, below zero on this chart. And when you're below zero, that's usually a bottom, and that usually leads you into some kind of a recession on the way back up. But this time, the bottom edge has been on an uptrend, if you can see here. And this spread has happened since the 40s or whatever. And so this doesn't tell you what the interest rates are. It just tells you if the long end and the short end are spread. And so this is the kind of inflationary deflationary cycle that you get, and this spread is painted along that. Well, it's been a deflationary trend since the 70s, but you can see here this is like the 90s. We got the 90s recession, 2000s the dot-com bust recession, and then 07 here we went into the 2008 housing crash, financial crisis there, and right now we're ripping up. And we didn't go negative this time. So this is the first time in 50 years that we did not invert the yield curve. It went flat. And now we just saw the long end of the curve is going up. But usually what happens when it inverts is you get the short end diving and the long end kind of stays still on the way up. And that generally leads you into a recession. And that's a continuation of the deflationary trend. So I guess more of an inflationary argument here to do with U.S. interest rates is that we did not invert. So that's a change sort of in the pattern. And not only did we not invert, but now the short end is staying near zero and the long end is pushing up, which is a different, like it is pushing up. It looks the same sort of on this chart, but the fundamentals of why it's going up are a little bit different. Like usually the long end stays still and the short end goes down, and then you get that steepened yield curve. And so we are getting a steepening yield curve, but it's actually the short end is staying still and the long end is pushing up. So that kind of switch in fundamentals, and we didn't invert, could mean that we're switching into an inflationary environment. I don't mind that argument at all, but I just would like to point out that we're about halfway up, and it usually cycles all the way to the top. Like it's a pretty reliable cycle. So I mean, if we, it usually gets choppy near the top, comes up here, chops and comes back down, something like that, right? So if we did that and we land higher on this chart and we land higher on treasuries, like then I'll say like inflation is pretty obvious. But this is only the U.S. Treasury bonds, which are, the U.S. Treasury bonds are fundamental in the international banking system. They do matter a lot. Like, this is the key reserve asset in the international banking system. So this chart is really important. The M2 money supply is a little trickier because most of the dollars are not in the M2. I mean, we have bank loans all over the world that aren't in the U.S. system. There's tons of derivatives. There's tons of money going into like the stock market and stuff like that. So the M2 is a little bit fuzzy, just because it's domestic only, and that's not even where the dollars are coming from. So the M2 is a weird one, but so anyway, the short-term inflationary argument is pretty strong because the M2 supply blew up, the treasuries are going up, but this is a short-term trend. It could be a counter trend. And next time we cycle down, I mean, we could hit lower. So the jury's still out kind of on longer-term inflation, but short-term we're getting an inflationary move. It's a reflation trade. And so I want to jump over to the eurodollars because that is that's like the international bond trading. So GE, not General Electric, GE futures, the eurodollar futures. So here's the in front contract, and you can kind of see, how far does this thing go back? To the 80s? Yeah, so this is the deflationary trend showing in the eurodollar trading. And you can see it's kind of squeezing down. And each time we get a down move, that's like the inflation bet. It's the reflation trade here on the way down. But we keep pushing towards deflation. And every time we get a counter trend, like, it just keeps squeezing and getting smaller and getting smaller. And like the continuous in front contract shows no indication. Like we just saw in the U.S. Treasury yields that we're getting an inflationary move, but the eurodollar bond market, which is connected to the LIBOR rate, like the London interbank rate, is like the world, sort of the world bond trading rate. The eurodollar futures are just not showing that anyone's betting on inflation. And so this includes all the smart people. This is like everybody that trades in the international fixed income markets, the bond trading markets. This includes the entire international financial system and the repo market. And the repo market mostly functions on treasuries right now. That's what all the international banks trade around on overnight trading in order to have collateral to create, all the loans and the dollars in the international banking system. It trades mostly on U.S. treasuries. And yeah, anyway, this like immediate is like zero inflationary outlook for everyone in the international banking system. So regardless of what the media is saying, or like the U.S. Treasury rates are saying, or the Fed funds rate, any of that stuff. I wonder if we can get the Fed funds up here. But let me go to, like, this is the in front contract, but you can go out to, say, like the end of the year. And let's see what we get. So it doesn't go back as far because it's a forward-looking contract. But you can see if we go out a year, it's not pricing in any inflation to the end of the year, or go out like 3 years. Okay, so now it's pricing in some inflation, and it doesn't go back as far. But this is sort of the reflation trade. So looking forward like 3 years, the international bond market is saying like maybe we get a little bit of inflation, but nowhere even close to the previous inflationary top. Like the international bond market is not betting on inflation, and it's not betting on it going back past the previous top for sure. Like this is it, like this little tiny bit of inflation, that's looking at 3 years. And so that's, the international banking system is like, no, we're not getting inflation. Basically, just looking at the eurodollar charts, Let's look out farther. What's the longest we can look out? Oh, it goes way out. Yeah, you can go out like 10 years. There's probably no history on this chart. Yeah, that's not super helpful. This is a brand new contract that has no history. So that's, yeah, it's not useful. But maybe just look out like 5 years. Let's see what like this thing looks like. Does it have the previous trade? Yeah, so like looking out 5 years, you can still get the previous reflation trade in here. But you can see even 5 years out, it's only halfway to where interest rates were, you know, in 18. So yeah, so anyway, the international bond market, the international financial system that completely operates using treasury bonds is saying no, just saying no to inflation. Like, no, this is not a long-term inflationary thing. Like, so who do you believe? The US media or the actual bond trading from all of the international bond traders and the international finance people and the international hedge funds? Um, who's probably better at predicting where interest rates are going to trade? I'm probably betting on these guys. So that's kind of just looking at interest rates and bond trading. That is kind of the outlook. It's like we're in a short-term uptrend in the U.S. market, but just looking at the long-term bond trading outlook across the whole world, like the banking system does not expect inflation basically, and they operate on Treasury, so they're not joking around with this. Okay, what was I gonna look at? I forgot. I was gonna see if I could get. I wonder if I can get like the Fed. No, I don't know. Oh yeah, you can get Fed funds rate. This Fed funds rate follows the U.S. Treasury trading. So basically, I can show what the Fed is doing with regards to the U.S. Treasury rates, and this goes back to the 50s. So this is really cool. So you can see the inflation move here started, you know, in the 40s, boom, and it like went almost to 20. This is crazy. So interest rates in the 80s, like 81, 82, were up at 20%. And this is where Volcker came in as the Fed chair, and supposedly Volcker jacked the rates up to this point to kill the inflation. But I mean, really, these rates don't come from the Fed chair. They come from the market inflation expectations and bond trading. And so I like to point at this chart and just show, look, it cycles, it cycles, it cycles, it cycles, it just cycles. But the cycle, where it is in the cycle, doesn't show the overall trend. And so we've come down and smashed the zero bound here on the Fed funds rate. And this is like the interbank kind of loan rate in America. And it's a good look at like where the interest rates are for US trading. But everyone thinks the Fed sets this rate. And if you see this side of the chart, it's really natural. It looks like a normal trading chart. And then if you start getting into the 90s and stuff, you see these flat edge moves where it's just kind of weird and then it'll break away from it. Like this is where the Fed is trying to set those rates. You get this weird flat edge. Like let's zoom in on this a little bit closer. Was I already on dailies? That's as tight as it gets. Okay. But anyway, you can see it's just doing normal interest rate cycles. But you get these really weird edging, flat edging shapes. Like that's the Fed like trying to set the interest rate. Like they're just announcing. It's like a news release. They're just like, this is the interest rate right now. And as soon as the bond market trades away from that interest rate, they have to announce a different one. And so right now the Fed is still announcing like almost zero Fed funds. And they're like, we're not going to change it. And you can see it's like trending down. And this was only at 2 point something last time it went up. But yeah, I mean, they announce a rate and then it trades away, and they have to come out with like an emergency announcement sometimes. Like right here when they're like announcing this rate up here at 5, and then all of a sudden it's like, oh, it's 2 all of a sudden. Like, you didn't set it at 2. Like, the bonds traded down, and then you had to like come out with some emergency announcement, and then it traded down farther, and it's like, oh no, another emergency announcement. We're at 0. Like, the Fed didn't do that. The bonds just traded down there, and the Fed guessed wrong, and then they had to come out and announce where it actually was. That's all. The Fed's not controlling these interest rates, and they're definitely not controlling the international rates. But I was thinking about like what the Fed does. All right, let's get back to like what the Fed actually does, because they're not printing money. Like, the Fed bank reserves are not money. The Fed bank reserves are only useful in the U.S. banking system, and they only limit the amount that U.S. banks can print, like new loans that U.S. banks can create. It's the Fed's ability to limit U.S. bank lending, so they can limit inflation, but they can't create inflation. They can't force banks to lend, and that's only in the U.S. And I've been saying a lot that the Fed has like almost no influence on the international banking system, but that's not really true, because the Fed can buy up treasuries, and those treasuries are the main, and mortgage-backed securities. And treasuries and mortgage-backed securities are what the whole international collateral system, the repo market, operate on. And the Fed can buy them up and decrease the amount of collateral in the international system. And I haven't heard a lot of people talking about that, but that's exactly what happened during the COVID crash. We got a contraction in the international system, and then the Fed bought a bunch of treasuries out of the international system and decreased the collateral, and that accelerated the down move in the COVID crash. And then at the bottom of the COVID crash, then the government, Congress came out creating a ton of new treasuries, and the Fed didn't buy those all up. And so that increases the amount of collateral in the international system. So I think the U.S. Government and Fed actually do have more influence on the international system than, well, most people don't even realize what's going on. But the people that do talk about the international system, like Jeff Snyder and stuff like that, like mentions this a little bit. But most of the people that talk about this say that the Fed's not controlling anything. And I think they do control it more than people think, but not in the way that they think. This is what it looks like to me. And so if the Fed is buying treasuries, there's basically two different things. Like, there's like the helicopter money thing, right? The Treasury has Treasury General account, which I call the helicopter general account. Is there a TGA chart on here? Let's see. Treasury bond futures. Nah, it doesn't have like the TGA on here. But yeah. Anyway, so if the U.S. government, if Congress creates new treasuries, and the Fed buys them all up, they don't go into the market, and the Fed just holds them on the balance sheet. But when the Fed buys treasuries from the government like that, like, they still buy them through the primary banks, but they're just basically buying them from the government. Then the Fed puts bank reserves into the Treasury General account. So Treasury has basically a checking account at the Fed called the TGA. That's the Treasury General account, and that has bank reserves in it. They're not like M2 dollars. They're bank reserves. But the Treasury can magically spend bank reserves into the normal economy. Like, it will take a bank reserve out of the GTA, and it becomes $1 in like some, government employee's checking account. So that's helicopter money. The Treasury can take bank reserves, which aren't money, and deposit them in somebody's checking account, and they are money. That's helicopter money, and that requires both the Fed and Congress working together. Fed has to buy treasuries from the Congress and put money in the TGA. the Fed prints up new money and puts it in the TGA, and then that new money goes into the economy. Two-step process. Anyway, that's one thing for treasuries. The other thing that happens with treasuries is people buy them, like banks buy them or individuals buy them. And then when people buy all the treasuries, then they're out in the general market. And when they're in the general market, then the international banking system can use them for collateral and for creating new loans. And so if the Fed starts buying those treasuries up like they did during the COVID crash, that's reducing the collateral in the system. And I think it's something like 80 or 90% of all the collateral in the repo market is now U.S. Treasury bonds. There used to be way more mortgage-backed securities in there before the huge, housing crisis, and now nobody trusts mortgage-backed securities. And the international banking system mostly just operates on short-term, like overnight lending of Treasury bonds. Anyway, that's a look at just how treasuries work and how the creation of money works. Like there's helicopter money and then there's bank loans. And most all money in the world comes from bank loans. And since the 70s, most all the money in the world comes from bank loans outside the US from international banks. But that money does find its way back to America. So you see the M2 going up. It looks like a bunch of inflation. And it is. Short term, it's inflationary. But let's look at gold too, because there's other monetary assets that sort of play into the inflationary idea. So the idea for inflation is interest rates. You want interest rates going up, right? And then gold should be bulling if we're getting inflation. And gold has not been bulling. Gold's been bearish for a long time, since the middle of last year. So that doesn't look inflationary. You should see monetary assets going up, but Bitcoin has been going up. And this is sort of the counter. It's been going up. And I say that like right when Bitcoin's making a big down move. But I mean, you can see since, what was it? It was like the middle of last year or something. Gold was doing bearish moves, but I mean, Bitcoin obviously took off, well, this year. And so people are saying like, okay, like gold is not going up right now, but Bitcoin is going up. So maybe that is like the monetary asset part of the inflation argument. But yeah, for inflation, you really want to see interest rates going up. You want to see monetary assets going up. And then consumer prices you want to see going up, which we have seen consumer prices go up this year, notably. But we also have a huge supply shock in the international logistics chain. Like goods and services aren't traveling between countries. They're not getting manufactured because the supply chains all broke down. And so our price is just going up because supply is getting jammed. Like that doesn't necessarily mean that you're getting monetary inflation just because the supply chains are jammed up. So that's all kind of tricky. And then there's the inflationary argument about like technology being deflationary. Basically, you invent new stuff, new manufacturing, new technology, and that makes everything less expensive just because it's easier to make more, better stuff. And so basically that's the supply side of the argument, is tech increases the supply side. You get more stuff, better quality, easier and cheaper as tech improves. And so that's deflationary, but that's not like monetary, deflation. That's just the supply side improving naturally. But the government will take every opportunity to like increase taxes as people get wealthier because technology is improving things. The government will see that as more money they can take. So I guess that's just the explanation kind of how inflation sort of works. And yeah, so I mean, I guess like right now, short term in America, we are seeing inflation, and that's probably going to continue for several more months. Here domestically, We have most of the inflationary situation and indicators happening here short term. But just looking like long term, mostly at the eurodollar system, it does not look like monetary inflation is even really being considered by the international banking system or international bond trading, people. So it would be really hard for me to take an inflationary stance like right now, just looking at those charts. Even though everybody is just like, not only are we going to get inflation, it's going to be like high inflation that like spins out of control into, hyperinflation or something like that. That might be a good topic to chat about, the hyperinflation thing, because people always point out, well, Germany, they always point out like Zimbabwe. So let me talk about hyperinflation. None of those examples that people give is a world reserve currency country. Like there's only been a few world reserve currency countries, and they have gone into high inflation, a lot of them. But let me talk about the hyperinflation thing. That is a country that's not a world reserve currency. Like Germany after World War I had a ton of war debt put on top of them, where they were in an insane amount of debt where they couldn't even function, and their entire economy production was collapsed. And so, well, if you just look up like Keynes, um, John Maynard Keynes said like, the hyperinflation thing is just a straight up like trick to get out of debt. And like Germany did that on purpose just to get out of their war debt. But I mean, they had like a collapse in their underlying economy, and then they had like a ridiculous debt load, and they're not a reserve currency. So, they can print their money out of control without like messing up the international system or anything like that. And Germany did that and got out of their debt. And if you look at Zimbabwe, like that's the most famous, like craziest case probably for hyperinflation. I guess I could talk about Venezuela after, but when what Zimbabwe did is that it was a agricultural based economy, and they had a bunch of farmers that were good at farming, and then they had government policies that took all the land away from the people that were good at farming and gave it redistributed all the land to poor people that weren't immigrants, like the local people. Which sounds cool, except they couldn't farm, and it absolutely collapsed their entire agricultural economy. Like their economy collapsed, and then they started printing more money to try to make up the difference, and that doesn't work. Like that's where you run into like the hyperinflationary problem. Like every case of hyperinflation, you have the underlying commodity kind of economy get destroyed. And then you try to solve that with money printing, and it doesn't work. You get hyperinflation. That's the same thing with Venezuela. Like Venezuela is an oil-based economy. Their entire oil production completely collapsed. Their whole economy collapsed, and then they try to fix that with printing. You go into high inflation. I guess Venezuela is the example, the stock market example. I don't know if you can get like a Venezuelan stock market on here, but I'm sure everyone's seen the Venezuelan stock market chart. Like it just like goes to the sky, and that's not because their stock market's doing well. It's just because they're getting high inflation, and so priced in Venezuelan dollars, the stock market looks like it's going crazy, even though it's probably crashing as the currency inflates. But it's a completely different scenario with the U.S. as the world reserve currency. Like when you're looking at the economy, you're not looking at just at the U.S. economy even. You're looking at the economy of the whole world. And yeah, it's not really the first global world reserve currency. There's been several. I mean, if you go back, like Mongolia was a pretty big reserve currency that was not global, but it was huge. And then there's like Portuguese, Spanish, Dutch, French, the British Empire. Like over the last 600 years, there's been all of those. And most of them have done some kind of inflation or high inflation near the end of the reserve currency, kind of when the empire was collapsing. Like the Dutch, their currency was the guilder. Like they did high inflation. It's a cool example because their stock market crashed. Like that was one of the first legit stock markets, and their stock market crashed as they went into high inflation, and they lost their reserve currency. Um, Spanish had silver currency, and they actually mined so much silver they got an inflationary crisis. Like the French Empire, they had like land-backed paper currency that they printed up uh, heading into the French Revolution. They had high inflation. The British created central banking, and um, yeah, they debased the sterling. It used to be like pure silver, then they reduced the amount of silver in the sterling. But then they also printed bank money, kind of heading into World War I, which is where they kind of got in trouble. And then, yeah, I guess inflation near the end of a reserve currency empire is super normal. It doesn't always result in asset prices going up, though. Like if you look at the Dutch, like it didn't go up, even though they did high inflation. Right. So, yeah, I guess the inflation argument, that's what I am. I'm US domestic short term. I have an inflation outlook for like 6 more months, maybe, short term in the US, just domestically. But as far as the international interest rates and everything go, it doesn't look very inflationary. And so that, well, what are the knock-on effects of that? Let's think about it. Um, I mean, that's probably not good for monetary assets. Like if we have a short-term inflationary burst, uh, if that dies out, then these monetary assets aren't going to look very strong. Bitcoin, gold, silver, that kind of stuff. What's silver doing? Silver just looks like it's on a big bull flag. It just looks like it's crossing this consolidation zone. So, I mean, I think it's useful instead of diving like way too deep into theoretical stuff. And there's a lot of different examples in history that kind of conflict with each other. But like this looks bullish, and it is bullish until it's not. Like if this breaks down, that would be, kind of a deflationary look. If it breaks out, that's kind of an inflationary look. Because silver is both monetary asset and it's commodities. So you're getting sort of the consumer price side of inflation, and you're getting uh, the asset price inflation at the same time with silver. So if you get both of those together, silver should bull out. It's like silver's like the ultimate like inflation asset on both sides of the coin. Gold, you're only getting like the monetary side. Where's gold? So the monetary side, like this makes no sense, right? I mean, the M2 has freaking blown up, and gold's going bearish. Like that's just weird. Yeah, maybe that has to do with Bitcoin, but that's pretty strange. And then why is the Fed gonna stop printing the M2 chart? Like that's weird. Like is the Fed trying to hide what the M2 supply is about to make a huge move, and and who knows in what direction? Like it could freaking crash. Like if banks call in loans, if they stop lending, like the monetary supply will just freaking destroy itself. Or if they print more, like it can explode. But it's not like a stable thing. It's really dependent on the lending. Man, if the freaking M2 goes black, that's really sketchy. And then there's like copper. Let's see. What are the copper futures? So if you look at something like copper, I forgot what the symbol is for copper. This is it, HG. Yeah, here's copper futures. So if you just look at copper, so yeah, if you look at copper and gold and silver, you can kind of get, like, copper is like the commodity, sort of, not consumer price, like the price of bread, but like the commodity prices. Copper is a good indicator for the price of goods sort of internationally. And so, I mean, copper's been bulling out. and lumber has been bulling out. And so you get this consumer price inflation move here. And this is a breakout of a big consolidation area. This is a big freaking breakout move. On sort of the price of goods, but the price of monetary assets is not doing as well. Yeah, so anyway, that's a look at inflation. It's a complicated topic because you have to really define what you even mean by it. Like, is it the amount of currency units? Is it the amount of currency units above the interest that's owed? Like, I think that's a better way to look at the currency side of it. And then, are people spending it? Like, if it's all in savings account and no one's spending it, like, it's not going to be causing inflation, but there's like inflation potential. If people have a bunch of savings that they can spend, well, then maybe they will, and then you could get inflation like at random whenever that happens. Yeah, and then there's like the velocity of money kind of thing. Is there a velocity chart? I don't know. Maybe like M2 velocity. Oh yeah, there's a velocity chart. Oh, that's kind of cool. Right, so here's like into velocity. What, they stopped printing this thing? Yeah, this chart's not too helpful. It looks like they stopped printing it last year or something. But you can see the velocity of money just fell off a cliff. And it's been, this goes back to the 70s. Yeah, right, so the 90s kind of velocity peaked, and we've been in a huge downtrend in velocity of money. So people are spending less and less money. And so that's sort of deflationary. Like if you have money but nobody's spending it, then prices aren't going to go up. So, yeah, anyway, I guess the inflation topic is just a little bit complicated to define what you mean when you're saying inflation. And then I guess most people are saying, like, if it is inflation, what does the stock market do? And that's not obvious. Like, if you look at Venezuela, their stock market went freaking vertical as they went into high inflation. But if you look at the collapse of the Dutch Empire, their stock market freaking collapsed while they had high inflation. So, yeah, I don't know. The stocks are hard to determine. It's not like the flow of like buying bread is completely changing what the stock market is doing. Like this mostly has to do with, loans, like margin loans coming into the stock market. And there's other flows of money into the stock market, but that's the huge thing is margin. So yeah, anyway, that's like a long-winded discussion of like what inflation even is. And I think looking at the interest rates is probably the best measure of that. And I think the EuroDollar chart shows that the international markets and the international banking system just does not expect inflation in the interest rates. But, the consumer prices and the stock prices and stuff is more complicated. So, yeah, anyway, this is not investment advice, even though I don't think I gave any. So, yeah, what do you guys think about inflation? That's a deep dive into all the kind of inflationary concepts. And it really doesn't paint like what the stock market's doing. Like just looking at the stock market, I'm really just like looking at where this is new money coming into the stock market this whole last year, and where has it been coming from? We saw, like when the Archegos thing blew up, we saw that there's a ton of money, billions and billions of dollars per hedge fund coming in from margin loans that are not on the books. Like they're doing these bank swap margin loans that aren't not reportable, and you only see them like when a hedge fund blows up. And so for now, that's continuing, and who knows how long that could go on. I don't know if there's some sort of upper limit where that gets in trouble from a theoretical perspective. But I would imagine if you see hedge funds and banks like blowing up, that would probably be a good time to be concerned. Maybe too late. But just on the chart, I mean, this chart is basically a flow of money into the market or out of it. So yeah, so I mean, we have these resistance levels where it's a high probability that money comes back out. And so we hit that one here. So I guess there is some percentage chance that this little peak is actually the top of the whole stock market. But I don't think that's happening. But I think there's a much higher percentage chance that when we get up here to the top of this bull channel, that is much more likely to be a long-term top. I'm out on the daily chart here. So you can see this is the Volmageddon crash, beginning of 2018. We had the crash at the end of 2018. This is the 2020 COVID crash here. And this is our long bull channel back to 2008. And so we've just been bulling it up since the financial crisis. But these chop downs out of the channel are dangerous. And we're back in both bull channels right now, the little one and the big one here. And I think when we get to the top of both of these, this market is going to be in big trouble. Like right here, 43.50, May 21st. If we hit this point, it's going to be pretty dangerous, especially if we're up here past the little bull channel. There's really no support into June. So yeah, I mean, we're coming into May now. So I think May could get dangerous, and then June could get really dangerous. And yeah, and we don't really get to see the money flows. Like, it's not like data that random people like me have available. So it's not like, oh, like the money supply is just gonna like reverse on this date or something, so get out of the market. Like, maybe there's a bunch of bankers that know that. Or maybe they'll get surprised by it. I don't know. But anyway, that's the look for now. We're in the bull channel. It looks like we're kind of caught under the previous peak and doing like a little consolidation stuff in here, which could go out into next week. And yeah, this bearish line down here, I don't know if that is a bearish line to follow out of the channel. It looks like that was just the pattern for crisscrossing the channel here. Like, I don't know, I drew this thing like all the way down to the bottom. I think that's a little bit excessive. Well, I mean, when I drew it, there was a potential that will come down and tag it, but I think the odds of that are way down. So, I mean, this looks like we just kind of crossed the channel on that trend line, and now we're just consolidating in here. So that's the next look, is just see if we break out of either side of this channel, see if we consolidate, and